our conversation now is Todd Rosenbluth. He is head of research over at VettaFi. Todd, it's great to see you.
Great to be here, thanks.
Let's start with the flows. Like Eric said, it's been a banner year so far. You think about the totality of the year with less than 6 months to go. Is this going to be another record year for inflows?
It's certainly setting the stage for it. We typically see strength in the third and fourth quarters relative to what we saw in the first half of the year. I think we're going to see a number of funds. Eric showed that Vanguard with its 500 ETF, IVV, its BlackRock's 500 ETF, those both could set the records. So we're seeing strong interest in actively managed ETFs. That's helping to push up. It's about a third of the overall flows. We're really excited at VettaFi at the adoption of ETFs. Thus far this year, we think we could see a record by the end of the year.
So speaking of record highs, or records in general, stocks are at record highs as the economy slows down and people think that the Federal Reserve is getting ready to step in. This earnings season is really critical to justifying the 2024 rally and keeping it going. From an ETF perspective, will the big bank results that start coming out on Friday kind of set the tone in terms of how investors position themselves for the second half, or does that not matter until big tech reports?
So I think it will matter because we've seen the sector ETF flows be dominated by technology, communication services. Those have been leading overall. So if we see strength for the companies that are in the more cyclical parts of the economy, in financials, in energy, in materials, we see a broader market, that's going to be a good thing. The mega cap growth stocks that have been leading the market higher, many people are concerned about that and they're looking for other alternatives. So I think it's a good sign if we see the fundamental strength within the banks that are kicking off this year. And of course, XLF is one of those great ways to get exposure to it.
Now let's